You might take up to 15 seconds. It's saying we are live.
We're live.
Welcome, everybody. Thanks for joining us. I'm Greg Reese. This is Paul Brar. We're with Reef Point LLC. Serve as independent trustee for the tax deferral strategy known as the Deferred Sales Trust, which is highly specialized and niche. And today we wanted to talk about a question that really comes a lot to us from our clients, our partners, et cetera, because what we do is really very niche. It's very specialized, and people often wonder, are there other firms doing what you do, or are there other people specifically doing the Deferred Sales Trust? And one thing that comes up is a structure or a concept known as the Monetized Installment Sale. So we're going to talk today about the differences between the Deferred Sales Trust, the Monetized Installment Sale, and try to separate some facts from fictions, because there's still folks out there trying to promote the Monetized Installment Sale, but the IRS has pretty much weighed heavily against that, which we'll discuss. And so, Paul, maybe you just give us a quick overview. We'll start with the Deferred Sales Trust overview, and then I'll go ahead and chime in about kind of how the Monetized Installment Sale works.
Yeah. So DST, what we do, legal proven, IRS tested tax strategy, which is the key part when Greg gets into MIS. Keep those words in mind, IRS tested. This is designed to help sellers of highly appreciated assets defer the ordinary income tax and capital gains over a period of years instead of paying them at closing. So Deferred Sales Trust gives the seller/taxpayer the ability to control their capital gains tax exposure by deferring it, reinvestment terms, and installment payments made from the trust. So this is what we do, and the differences that Greg will walk everybody through. What we do is a very risk-free setup, which includes everything is conditional. There's no upfront fees for what we do, but it allows the seller to have a strategy in place so they're not going in blind or saying, hey, I closed last week. Now my CPA is telling me I owe all these taxes. What do I do? So getting this set up in advance benefits the seller. It benefits the professional partners that we work with that serve these clients, business brokers, CPAs, M&A consultants, realtors, et cetera. So there's a 3-member fiduciary team that serves the DST, our tax attorney, the independent investment advisor, and then the independent trustee, which is Greg. So that's a little bit high level about the DST, and we'll dive right into the Monetized Installment Sale, Greg.
Thanks, Paul. So, let's first talk about what it is and what the similarities are. All right. So both the Deferred Sales Trust, or DST for short, and the Monetized Installment Sale, or MIS for short, are independent structures. They're not related to one another. They don't involve the same principles at all. The Monetized Installment Sale was promoted primarily by a group called Escrow Collateral. Stan Crow, non-attorney, by the way, had spearheaded this MIS strategy. Both strategies purport to operate under IRS Code Section 453. So let's talk about that for a second. So 453, I always remind people that are involved in real estate investments and sometimes have done what they refer to as like-kind exchanges or 1031 exchanges. The code section is 1031, which is where that comes into play. 453 of the IRS code involves the installment method of selling highly appreciated assets. And there's a simple definition for what constitutes an installment sale, which is that when selling an appreciated asset, you are choosing, instead of receiving all of your proceeds in the year of sale and therefore owing all the tax, that you're electing to receive some of your proceeds in one or more years after the year of sale. And in that way, the rule set surrounding 453 is that the seller only has to recognize and pay taxes on the funds they actually choose to receive from year to year, thereby spreading out their capital gains over potentially many years or even decades, because there is no statutory end date to how long an installment arrangement can actually go on. Usually you'll have stages, like we'll do it for 5 years or 10 years, and then the the seller has the right to renew it for an additional period of time if they so choose. So that's really the highlights of 453. The code's pretty straightforward. And the way it's applied, though, can be very different. Okay, so let's take the monetized installment sale overview. This is a strategy that purports to allow sellers of highly appreciated assets to receive immediate liquidity in the form of a loan. This loan is secured against 2 to 4 letters of credits by independent banks, and then a fourth or a fifth bank comes into play that actually makes a loan back to the seller. And then, it's purported that because it's a, quote, a loan, that it's not taxable to the seller. And there's various steps involved in making this work. So the IRS has scrutinized the monetized installment sale. But before I mentioned that, let me back up a little bit. So the Deferred Sales Trust was originated about 27 years ago, so the mid-1990s. Our tax team are really what I call the architects of this particular strategy. They've successfully closed north of 4,000 transactions, totaling north of $200 billion. And during the first 12 years of operations, the IRS picked around the edges a little bit. This is kind of how they would typically operate if a sponsor or somebody is coming up with an application of the law that maybe hasn't been done in that way before. And so they conducted about 16 field audits on the DST over the next 10 years of operations. After about 12 years, they invited our tax team to meet with IRS officials for about a week and to ship out 10 years worth of transaction records so that they could review them together in person for about a week's time to determine if there was anything about the mechanics or the structure or the application that the IRS would or would not like. And so that is kind of their method of operating. If they see something egregious right off the bat when they're doing individual audits, they may move to do a deeper review sooner. But what they like to tend to do is give you enough time to complete a number of transactions so that when they do a kind of a comprehensive review with you, if they don't like what they see, then they've got an easy path back to all your customers to do audits, assess penalties and fines, or whatever interest may be the case if they feel that the strategy was done inappropriately. So with the DST, took about 10 to 12 years before the IRS did their first deep dive review with our team. They concluded that everything that we were doing was legal, and they did not have any recommendations on making any changes or tweaks to it. They said, what you're doing is in compliance with the code. It's complex, but it's in compliance. And so thereafter, there's been additional reviews with the IRS, additional audits. Every review, every audit has resulted basically in what they call a no change letters, which means that we have a perfect track record and there's been no adverse findings for any of our clients. Now, the monetized installment sale, they came on the scene in the early 2000s, so probably 7 or so years after the Deferred Sales Trust really hit the ground. The IRS followed the same pattern. They may have done some audits along the way, but they in 2019 they had approached the proprietors of the monetized installment sale to undertake the same type of review, 10 years worth of records, come meet us at our offices, get a hotel room, spend some time, and we want to go through what you're doing. Well, escrow actually resisted that. They did not want to sit down with the IRS, and they fought them. So they filed a lawsuit in federal district court in Idaho to prevent the IRS from accessing their records. So they didn't go the easy route. They went the hard route. And of course, you go up against the IRS, they're not going to just walk away. So, it did buy them some time, a few years. I think this thing started, around 2019. It bought them a couple years just dancing around the legal issues of getting records. But at the end of the day, the IRS did get what they wanted to see, and they came up with a conclusion that the monetized installment sale was an abusive tax shelter. They referred to it as as a step transaction or an illegal step transaction. And there's a lot of moving parts into what they do. And we'll do a little compare and contrast at the end here. But there's so many moving parts in that the fundamental issue that exists, however, is the seller taxpayer actually receives the proceeds of sale shortly after the sale occurs. And it takes, several steps. First, we're going to use this company who's going to buy your home from you on an installment note contract that's interest only for 30 years. Okay, so that's the initial sale. Then the MIS sponsor resells that property to your buyer and receives the proceeds or the cash from the buyer, which is held by the third party, held by escrow as a third party. Escrow then arranges for the seller to get letters of credits from up to 4 different banks based on the fact that the third party is holding all of the proceeds of sale. And then they go to yet another bank and they say, hey, we want to borrow against this collateral. Well, the collateral is not your house anymore or your property that you're sold. The collateral is the money held by the third party, and they get that additional bank to loan the seller money based on the collateral that they do not own or control. Because what the seller actually owns is a right to receive the money in 30 years. They have an installment contract, which does not give them access to the money. It just gives them the right to receive that money 30 years down the road. Now, in the middle of all this, the third party is using your money and investing it however they see fit in order to pay the interest payments on the loan to the seller. Okay. And, it's a highly unusual situation. And the IRS, when they look deeply at it, they named 6 different things that was wrong with it. And I won't necessarily go into the list, but of course we have memorandum on this. If anybody would like to see it, we certainly happy to share it. Kind of goes through all the steps and why it doesn't work and what the IRS has said. So, that's an additional piece that if you're interested, we can provide to you. So, but the bottom line and the fatal flaw really resulted in, when the IRS started auditing these folks, and they're auditing every single one of them at this point, and they're probably still going through the process. But they say, let me ask you a question. You sold your property at a profit, so there's capital gains built into your sale, and you actually received the money less about 8% of expenses and fees that were charged up front. So you got about 92% of your sales proceeds, and you purport that you don't owe any taxes. That's right. And they say, why is that? And the typical answer is because they said so. So the whole idea was they were trying to conflate how the client received their proceeds and categorize it as a loan. Now, we all know, anybody that owns real estate or investment real estate in particular knows that you can refinance property that you own and you can pull money out, maybe for remodeling or maybe to buy another piece of property or take a vacation, whatever people would borrow money against their home or their real estate for, you can do that. And the cash proceeds that you receive on your refinance is not taxable to you. Okay. It would be recaptured. You're only going to pay tax when you actually sell that property. Of course, you have to pay off that loan in context with it. So a traditional refinance, well established, you do not have to pay tax on cash out proceeds, but it will catch up to you in the future when the property is sold, whether by yourself or by your heirs or what have you. And this has nothing to do with the concept of step up in basis here, just to be clear. So the idea was pretty ironic. You receive the money, but you don't owe the taxes because there's a loan. And they said, okay, well, all right, well, maybe we're not clear. So did you refinance property that you still own? And that's where the money came from. No, sir, we sold the property. Okay. And so how did you get the money? Well, we got a loan from a bank. Okay. What was the collateral? What was your collateral that was used? Well, we don't have any collateral, but this third party that's holding the money from the sale they have the collateral. So it was a whole cluster.
Complicated by nature, complicated by design.
Complicated by design. So, in a sense, while we still get a lot of questions about the MIS and wonder if it's the same thing as the DST, the answer is no. Is the IRS concerned about that? Yes. Are there still people that are trying to promote it out there? Yes, there are. They think that they might have created a tweak that makes it legal again, but it's on the radar now. It's actually, the IRS composes a list and they update it from time to time, and it's called the IRS group of listed transactions, and then the more common vernacular is the IRS's dirty dozen list. So the dirty dozen lists are those tax schemes that the IRS has deeply reviewed and has basically published in a list that these are abusive tax shelters and you should not get involved in them, because if you do, we're going to audit you and you're going to end up owing not only the taxes but some penalties and interests. And because they put it on their list of prohibited transactions, the penalties could be a lot higher for that reason. You should have known. In other words, you or your tax practitioner should have known better. So they're not going to treat you very kindly. So, with that being said, Paul, you want to do just a quick comparison, and then we'll do some frequently asked questions and a little head-to-head if that makes sense.
Yeah. So one of the things that Greg touched on the last slide was about audit protection, was about the audit defense of what we do, and we'll get in more deeply about how it works with MIS. But direct comparison, deferred sales trust versus monetized installment sale. Is it created off IRC 453 installment sale? Yes. The answer for both what we do as well as MIS, yes, created off IRC 453. In a deferred sales trust, though, you cannot borrow from the trust directly or indirectly. That's the whole loan explanation that Greg gave. In a monetized installment sale, you can. IRS approved tax deferral, deferred sales trust, 27 years, 16 field audits, 3 in-person reviews, all no change letters, which is the gold standard. MIS, as Greg detailed, absolutely not. They don't have that track record. Passed all IRS in-person reviews and field audits. Like I said, we have, MIS has not. And then this is really a key part, right? Standing behind what you do, not only us as trustee, but our tax attorneys, most importantly. With the deferred sales trust, you get lifetime audit defense protection of the trust. With monetized installment sale, you do not. They do not stand behind what they do. So really quick, going back to the last slide, let me just pull this up. Right here, where you put yourself at risk for it being disallowed by the IRS, leading to audits, penalties, and retroactive tax liabilities. There will be no MIS tax attorney standing behind you or in front of you to defend this. Whereas in a deferred sales trust environment, God forbid there's ever an audit of your trust, even though we have a very low audit rate, our attorneys will defend this at no cost to the client. So key things to keep in mind. Now, going into some frequently asked questions, our last slide here for the day. One of the key questions is, hey guys, we get it. There's a huge difference. One of the things, Greg and I get in consults, and I appreciate, we see a few of the folks that we did consults with this past week who are joining. They asked this exact question. So Greg, the question is, why are the DST and MIS confused and or linked to one another? Why does this happen?
Well, I think because they both purport to operate under the same well-established IRS code section. Keep in mind that Code Section 453 has been in the code for almost 100 years now. So it's not new code. And so it's been well tested and examined over the years. There may be some creative or some ingenious applications of this code or other codes, but really what it boils down to is, has it been is it legal and has it been tested? And if so, what level of scrutiny has been afforded? Because the devil is totally in those details. And so there are very foundational requirements to make what we do with the Deferred Sales Trust legal. There's independence between the seller and the trustee, meaning the trust, independence between the investment advisor that represents the trust and serves as fiduciary for the trust and the seller, but an independent relationship there is required. Do you follow the structures? Do you have a legitimate promissory note or installment note created? So, for example, any installment note has to be reasonable and customary in the IRS's eyes, has to pass the smell test. If you have a 30-year interest-only note where you actually don't get any payments, they actually make interest payments to a third-party lender who's not using your collateral but somebody else's collateral. But what you receive is a 30-year interest-only payment where the interest payments are diverted to a bank, not to you. So it kind of begs the question, if you're selling your house to me and you want to carry the paper for me, meaning that I'm not getting a bank loan, I'm just going to treat you as the lender and I'm going to make my payments to you and we're going to agree what those are. Is there any world where it's reasonable that an independent buyer and seller are going to come to an agreement where the buyer gets the property, access to use and enjoyment, anything they want to do, and the buyer makes zero payments back to the seller for 30 years? Is there any world that you can imagine where that sounds reasonable, normal, and customary? No, but that's exactly what the MIS does. And, I could go into a litany, which I won't go deep into this just because I won't, but, there's so many potential problems, even if it was legitimate, because after 30 years, if the third party still has your money, theoretically, they're going to give that money to you, except for the fact that they owe the bank first, right? Mm-hmm. So all that money has to be paid to pay off the loan. But don't forget, at the end of your note, you will have to have saved and invested a nice chunk of that money up front because you have to be able to pay the taxes at the end of the term of the note, even if this was legit, right? And so what if you invested poorly? What if you bought your kids homes? What if, you retired early and you really just didn't have even enough money to pay the taxes? Well, the IRS is not going to forgive and forget. They're going to go after you. And if you don't have enough money, they're going to forensically audit what you did with the money. And if you did anything to say benefit your family, buy them a house or cars or whatever, then guess what? They're going to go after those assets too. So, it's fraught with problems. There's all kinds of things I could say about practicality of what could happen to you when you have really no control along the way. But the mere fact that the IRS has deemed this to be an illegal step transaction, placed it on the dirty dozen list, the strategy is not legit. It's not legal. And, it took time, but the IRS finally, got down to brass tacks and details and did, a very deep dive review and came up with their conclusion. The same way they did with the Deferred Sales Trust several years earlier, only the results were the opposite. The DST has been deemed at every examination to be legal and proven at this point in time. So for those of you that are interested in kind of having a memorandum on the actual functioning or the how the monetized installment sale worked, happy to share it with you. If you have any questions about the Deferred Sales Trust, why it's legal, what the track record is, who it's for, does it work for you? Will it help you meet your objectives moving forward? We'd love to have a conversation with you. You can reach us either on our website, reefpointusa.com, or our toll-free number, 866-867-8633. So look forward to hearing from many of you with any questions that you might have.
We got a few questions, Greg, really quick, not to cut you off. We got a few questions.
No.
So Tom asked a great question. I thought the DST you are borrowing from the trust, and that goes into our second kind of FAQ right here, Greg. But if you want to just answer that directly, in the DST, can you borrow from the trust?
No, but kind of the relationship, if you want to kind of understand the relationship between you, the seller, and the trust itself, well, the legal relationship is similar to that of a lender and a borrower, where you're considered the lender in this equation, and the trust is the borrower, meaning that the trust has a contractual obligation to pay you back with interest over a period of time. not really any different than if you're borrowing money for a bank for a mortgage, for example, where you're the borrower and you have an agreement with the bank to make payments and pay them back principal plus interest. In this scenario, you're the lender, which gives you the right to dictate the terms of the loan and to have the ability for us to restructure the terms of the note over time if things change, or various things could change over time. So that makes it possible. And then the trust will actually make distributions to you based on the amount of funds that you want on a recurring basis, or if you need a lump sum, a walking around money at the close, or potentially an emergency occurs down the road and you need access to funds. Any funds paid to you are considered distributions, or where it might exist a partial prepayment. You and I have a mortgage. I prepay money all the time on my mortgage. I want it to last shorter than 30 years if I can. So I throw some extra money at my mortgage. The trust has the ability to throw extra money at you through prepayments if you have an emergency, for example. But what the trust cannot do for this to be legitimate is to loan you money directly or indirectly, because that would be seen as a taxable distribution to you. For example, just to repeat the relationship so it's very clear, it's like you're the lender and the trust is the borrower. We can't at the same time or through the process turn the borrower into a lender and make the lender a borrower. You see how that would be circular? The trust is the borrower and it owes you all that money. And now the borrower turns around and becomes a lender and lends it back to you. That doesn't work. Now, it doesn't mean that the trust cannot partner with you for certain types of investments that you may wish the trust to make or may be suitable for the trust to make, such as buying additional active real estate investments, or doing hard money lending, or investing in opportunities in private equity, just to name a few. But those things are done with you as investments by the trust, and any money that comes directly to you from the trust is called a distribution, and you'll be taxed only on what you choose to receive from year to year, while everything else is really sitting in that tax deferred environment, earning for you.
Yep. So appreciate that, Greg. We got 3 follow-up questions from Tony. Does the IRS require the interest be paid annually, even if principal is not paid? So that's question.
Yeah, great question, Anthony. No, it actually doesn't, but it goes back to reasonable and customary. So, for example, we gave an example of how the MIS works, where they give you a promissory note to pay you in 30 years with really no payments between now and then. That's not usual and customary, right? So the installment notes have to be reasonable and customary. So there must be some level of distributions, but it does not require that those distributions start immediately. They can start 1, 2, maybe 3 years into the future. You can determine what those payments are. So you have the ability to create a note obligation with the trust to say, I want partial interest, or I want, which means that any interest that I basically am due, but I don't choose to receive, you're going to add that interest on top of my existing principal. In the banking world, these were known as negative amortization loans, which you don't see much anymore, but they were used a lot in the 80s to help borrowers get into properties at a much lower cost, and they would allow the interest to accrue, some of the interest to accrue on top of the principal for the first, say, 3 years, and then they would reset or adjust. And that helped people get into property that they may not have been able to qualify for yet, but it gives them time to really get on their feet. So that's kind of the idea there.
Got it. 2 more questions from Tony, and Tony's a CPA, Greg, just so you know. Number 1, does the trust determine the type of distribution, i.e. principal or interest?
Similar to how a bank would create a promissory note with you, which is the mortgage. Along with the mortgage document, the bank prepares an amortization schedule for you based on the terms that you have agreed to, that will tell you for the entire duration of your term. Let's say we have a 10-year term with the DST. Based on the the amount of payments you want. That amortization schedule will inform you and your CPA exactly how much by the end of the year of your total payments are going to consist of interest and how much, if any, are going to consist of principal. Now, having said that, unlike a traditional mortgage on property where you're going to pay it down usually on an amortized basis, some interest and some principal, so that at the end of your term it's free and clear. In this scenario, most people do not want their note to work that way. They want to create stable, consistent income that meets their lifestyle needs, and they would also like the underlying principal to grow over time, keep pace with inflation, et cetera. So down the road, if I need to increase my payments, the value of the trust is building, so payments could be adjusted if your lifestyle needs change, or we hit more inflation pockets like we've been going through for the last 3 years. So that is possible. But so you'll know exactly what that is, but it's completely dependent on what the actual amount of dollars is that you want will determine how much of that is interest and how much, if any, is principal.
Yep. And then last question, which we're doing right now. So it's a great question to get. Does the trust issue 1099 forms for interest paid?
So yes, matter of fact, we're right in the middle of that right now. The trust does issue 1099 INTs at the end of January every year to every client, and we usually will copy your CPA. We usually ask for that information so we can get it to them as well as get it to you. We will also provide you with a cover letter, part of the reporting, which also will indicate if any amount of principal has been paid out to you through the course of the note, so that the accountant can, make those adjustments doing your personal returns.
Yep. Well, great questions. Great webinar, Greg. Appreciate all the insight. So guys, if anyone has any questions, or if you're watching this on our website later on YouTube, reach out to us. MIS, DST, lots of facts, lots of fiction out there. So we want to clarify any confusion that's there. We're happy to answer any questions, put an analysis together, make sure it makes sense for you as a seller, or if you're a advisor to a potential seller, make sure it makes sense for you as well. So reach out to us, like Greg mentioned, call our direct line, reach out to us via email, and we'll talk to you guys soon. Any final thoughts, Greg?
No, I think that's it. I just wanted to, answer kind of a question that we do seem to get on a fairly recurring basis, and it does cause confusion. So, hopefully this helps settle the score, so to speak.
Yeah, we got one last question. Chelsea asked, is there a minimum investment into the DST?
Great question, Chelsea. So, there's always a cost benefit analysis on anything that you might do, right? And so based on the cost structure associated with the DST, we basically have done the math, and you should be looking at selling an asset, appreciated asset, whether it's a business, whether it's investment real estate, whether it's your primary residence or a second home or a collectible, wherein the taxable amount on your sale would otherwise be at least $400,000 or more. That's taxable. So a property that you might have bought for $500,000 and you're going to sell it net for at least $900,000, which gives you $400,000 in profit, which is what the IRS is going to tax you on. That's a viable size transaction. Anything north of that is viable for the DST. If you have something where the taxable amount is less than that, give us a call anyway. We may be able to think of maybe some lesser strategies that might help you mitigate at least some of that tax obligation. But that's really the threshold right there.
That's it. And Chris, we'll get the recording sent out within a week. So you should have the recording within a week. All right. Well, Greg, great webinar. A lot of information, guys. If anyone has any questions, like we said, reach out to us, and we'll see you on the next one.
Thank you all. Talk to you then.